All right, drop down to a 1 minute chart. Looking at this chart like this, while we're inside of that larger weekly CIBI, I want you to take consideration about how I teach first presented fair value gap for the AM session. So during the opening range of 9:30 to 10 o'clock in the morning, as I was teaching the concept, because it's around the model that I'm taught my son Caleb, I gave him very specific rules. So he would have to use the very first presented fair value gap that he could use would be at 9:31 Eastern time. Between 9:31 and 10 o'clock, the very first fair value gap that forms on a 1 minute chart, that is his gap to use. Extend that throughout the day and throughout the week, and you'll see how they're used over and over and over again. I mentioned at the time when I first introduced this concept, I said that he would learn by experience when he could use the 9:30 1 minute fair value gap. It would take some time in looking at certain things. So I'm bringing in that now because I executed on it on Friday. You can watch the video that was posted prior to this one. But I want you to consider this candlestick right here. Now, normally, this would be your first presented fair value gap. But there's a criteria that I'm going to show you when and how I use the 931 as the very first presented fair value gap. Now, there's nothing inherently wrong with using this one. You know, if you extend that throughout the day, eventually you'll get something over here in the afternoon, but you're going to discover that it gets real wild in here and it doesn't respect it as much as the level of that 930 1 minute candlestick. Right, so take a look in the lower right hand corner. You can see that the chart now is toggled to regular trading hours, RTH. Okay, so we're going to see the gap, the difference between previous day's settlement price at 4:14 p.m. Eastern time to where we open at 9:30 Eastern time, the very next trading day. So it's not showing you all the fluctuations in price overnight in Asia, in London, and then before the new AM session at 9:30 Eastern time. So you have to be aware of that price action still, but you can't ignore regular trading hour structure, which is what we're showing here, okay? So if you take a very close look at where we opened up from where we settled previous Thursday at 4:14 p.m. Eastern time, we have a very large premium gap. That opening price here does two things. Number one, it triggers initial desire to want to be a buyer, because a lot of retail traders just see the price being flashed on the screen. It's like, well, yeah, it's a strong opening. But what do we do after we open? That's what a professional perspective is, not where are we at in relationship from the previous day's close to today's open. That's retail. That perspective, that measurement of bullishness or bearishness is identified through that lens. But a professional sees it from where do we open at and how do we close based on that open. And you want to think about that for your sessions, not necessarily just limiting it to the daily range in its entirety. You want to be thinking about from the beginning at 9:30 to say 11 o'clock in the morning Eastern time. So that's your AM session. Same thing for the afternoon. Where do we start trading at 1:30 p.m. Eastern time for that opening range for the PM session? What's that opening price? The very first tick at 1:30. Then where we close at 4 o'clock. That could be your entire afternoon range. And where we open versus where we close, that's the professional measurement of the lay of the land, how the market is delivered. So simply stated, we have a very high premium opening here. But if you're looking at regular trading hours, you're going to see that they opened it up above regular trading hours relative equal highs. So in here, we have Thursday's regular trading hours buy side liquidity. And now looking at this right there, this is your first presents a fair value gap. Because it's done a raid on previous regular trading hours, relative equal highs. And now with that opening here, we measure the opening range gap to find the consequent encroachment of that. As soon as we get the opening price right there, boom, you know that you're looking for 70% likelihood it's going to pull back into that opening range gap, 50% of it. Okay, so that's important to understand. When we see this, it's almost as if you have x-ray vision and you can read what price is reaching for and how it's engaging liquidity from both the regular trading hours market structure and also incorporating the same ideas with the electronic trading hours market structure, which we'll look at in a moment. But this right here, that consequent encroachment is that level right there. So it comes up later on, hits it. And if you look real close, there's going to be minor buy side liquidity rating here. So this white box is the opening range gap for the AM session. So that's 9:30 to 10 o'clock, that measurement. And we're looking for where we settled previously, which is here, and where we open. And that's what we're showing a depiction of that. Okay. So we're blending two elements there, time and price. And we're also blending in the elements of regular trading hours, time, and market structure, and electronic trading hours and market structure. So what do I mean by that? Well, before we do that, I want you to notice that we have all this run up in here without having the need to take out that low. I want you to take a look in this little area right in here and see if there's anything useful that you might see as, obviously for you, it's going to be hindsight, but for an educator's moment to point out something to observe before we get further into the video. Inside this area in here, if you don't take this low out and you're expecting the market to break down, what might you consider in this little area in here? Pause the video. I'm not going to pause the video, Michael. I dropped down to the 1 minute chart. Now I had this compressed and I'm showing it through electronic trading hours now. So I've toggled my ETH, RTH back to electronic trading hours. I have the range shown here that makes the opening range gap. That's that white shaded box here. If we're looking at how the market trades from regular trading hours and electronic trading hours, you have to look at the stops that are there. You have to look at how the market delivers to inefficiencies, from inefficiencies to liquidity, from liquidity to inefficiencies. And stripped down, let's just say you were looking at just the electronic trading hours only, and you didn't even refer to regular trading hours. I teach you that going back from pre-market session, 7 o'clock in the morning Eastern time to 9:30 opening bell, that 90-minute window of time, that could be your entire trading canvas where you do all your work there and you don't care what it does after the opening bell. There's plenty of opportunities to do that. Or you want to use a session trading to give yourself a little bit of a buffer and then trade heavier handed after you get the opening range and the true understanding of where the market's going to go after 9:30 opening. That's a little bit more advanced. That's what I usually do when I'm running up the accounts. I'll do things like that. I'll build in a buffer right before the major session I'm looking to trade. And that might be the afternoon. It might be I'm not trading in the morning because FOMC rate announcement's coming out later in the afternoon. So I will do very, very little light-handed trading pre-session because I know usually the morning session is going to be quiet, lethargic, choppy. And then after the initial distribution of price higher or lower at the 2:30 conference when they're now going to listen to the Fed chairman speak, that's usually the real move. And because I've done something early in the day, I've patted myself out. I would be willing to risk 50 to 75% of whatever I earned in that light-handed trading to leverage into what I think is the real move in the afternoon. So these are some of the things that I like to do and how I use planned leverage and light-handed trading, where I build a little buffer for the real big impactful event that I'm trying to actually trade that day or session. But if I take your attention back to some of the things I've taught, using the obvious pools of liquidity, they cannot hide it from you. Okay, you don't need level 2 data, you don't need volume profile, you don't need any of that stuff. Okay, you don't need none of those things. But it makes you feel and look intelligent in the eyes of other people. When they look at your chart, it seems scientific, but it's simplistically shown by looking at time first. So if we're looking at the 9:30 opening range, Eastern time for equities open, going back in time, what's the first thing you're going to run into? London sessions liquidity. Well, here you go. Here's London's low. What happens prior to that? Asia's sessions low. So those are two levels that we would be looking for when we have the market opening up, trading above this short-term high, this short-term high here, and then bumping it right there at the open. So just think about that for a second, okay? We have a blending of regular trading hours and electronic trading hours to see kind of like an envelope, a barrier at which we want to see price reaching for obvious pools of liquidity that doesn't need level 2 data. Is pointing to where was the high at, where was the low at in the Asian session, in the London session. And now we're building them for the morning session that can be used for the afternoon or lunch macro. So this little bump up here, taking out that high, that's something I pointed out to in one of my students' live streams, Dasha. You know her as Lumi Traders. So I shared that. I said I ran the buy stops here, and now I'm going to be looking for 21,360, and that's based on London low. Okay, so I have witnesses over there that'll corroborate and say, yeah, he did that, but without having the need to do that type of thing. I mean, obviously, I've been doing this enough now. If you've been following me, if you're a student, you know that there's no hindsight required. I'm pointing to these things. I just want you to look for these types of conditions, these setups, these parameters, so that way you can start to formulate a routine that you follow every single session. You're not trying to reinvent the wheel. You're not trying to complicate it. You're not trying to bring every tool, every aspect of whatever I've taught into every situation, because every situation doesn't warrant every PD array, every school of thought that ICT's ever codified. And that's you as a student, or that's someone that doesn't want to learn how to use this stuff. They just see all these tools, these concepts, these procedures, and they think, oh, who's going to do all that? Well, there's no application ever by me, or a instruction by me to try to throw everything I have into every situation right now. Looking at a chart, you're not going to have every PD array there. That's why knowing all of them generally is a good thing, but you're going to specialize in one or two, and that's all you need. And your setup might not form that given moment, and you let it go, and you trust that you'll find another setup. Or, and this is my hope, that you'll learn a lot of the continuation patterns that I teach with PD arrays, like volume imbalances, mitigation blocks, institutional order flow entry drills, that type of thing. That's why it's beneficial for you to know, like, month 4's content in my core content mentorship lessons. You can find that on the YouTube channel, where I'm teaching the PD array matrix and the general introduction to the basic PD arrays. Not all 81 of them, but just the most pertinent ones that I think that's going to be easy for the majority of all of you as retail traders, being able to see that in price action and how useful they are. So I want you to take a look at this. Buy side liquidity here, taken. Buy side liquidity here, taken. Buy side liquidity here, taken. And we're seeing this occur in electronic trading hours that leads to that big pump up that keeps us above the relative equal highs in the regular trading hours. Remember, we're looking at electronic trading hours here, okay? So this is one of the things that new students with me, or those that maybe already trade, but never know how to consider regular trading hours versus the effects of electronic trading hours, market structure. You have to blend both of them. And if you think that's a complication, I'm sorry, but it's going to require a little bit of thought. Okay. You're trading against the most elite minds in the financial world, markets, arena. You're literally up against juggernauts with billions and billions of dollars behind them, and complaining about how, this should be easier for me. Then I'm not your mentor. You need to go find somebody else, find somebody's moving average, crossover indicator, that type of stuff, and just do really, really good risk management, and you might be profitable. And I wish you good luck and God bless you, if that's what you want to do. But I just don't think like that. I want to know what's going on. I want to know how I can formulate a plan that the algorithm will refer back to the same things I'm teaching you. Everything stems from time, delivery, and then price. It's time for the market to do something before price will do it. That's it. The only time it doesn't occur like that is when there's a geopolitical upset, some kind of thing that you didn't see, a terrorist attack, a bombing, a war breaks out, an assassination, a terrible earthquake rocks a specific area. Anything of that nature that's an act of God, that you just can't predict those types of things. So apart from those things occurring and manual intervention, market's going to book by time-based delivery first, and it's going to refer to price when it's time to refer to price. That's what an algorithm does. That's what this price engine does. There is absolutely one algorithm on every instrument that is delivering price. It's not buying and selling pressure. It's this engine that keeps pushing, offering higher prices. No matter how many people want to sell it, it's going to keep ticking and keep ticking, offering higher prices. And because there's people always coming in at market orders, and because there's pending orders, there's always going to be a price that they can use, that the book. You only need one contract to cause the price to create the candlestick at that higher low. You don't need big volume. The folks that believe in volume having any real basis behind all this, it's infantile, because there's liquidity above the high that never gets tapped. There's liquidity below the lows that never gets tapped. What constitutes the reasons for why it doesn't get there? Because there's certainly not an unwillingness for people to buy and sell just because it went to a specific level. There's people that are stupid. They trade moon cycles and horoscopes and things like that. There's all kinds of nonsense that's constantly out there causing people to be impulsive. So why does the market stop at my levels? Why does it respect those types of things? Because I'm aligned with what the algorithm's going to do. I'm keying in on where the actual liquidity is, that you can just simply see visually. You don't need any kind of instrument, any kind of service that tells you this is how many orders are above or below this level or at this level. All those things could be faked. Big institutions do that a lot. They'll put a big order, a block of 500, 600, 1,000 contracts at a specific level, because they know all of you are constantly out here trying to find signs that the big guys are doing. And then because you see these big blocks of orders, you're going to naturally assume that, well, I think they're going to go up there and get that big order up there. So what is that going to do? That's going to lull you into and prime you to be a buyer until we get up and hit that level. When in fact, what they're doing is they're selling into that in smaller blocks as it's going up there. But right before it gets close enough, they pull that order away. That's spoofing. But you don't think that's going to be an issue for you, because everybody in the circles on Reddit and Facebook groups and Instagram and TikTok and X, you all think that makes you scientific. It makes you a professional trader. It makes you institutionally minded because you have level 2 data. All you have is a myth, because those things don't make price go up and down. A lot of those orders aren't even there. Actually, when you see price go there over time, the order size starts to diminish. It starts to diminish. And once you get there, look at the time in sales. A lot of times, the number of contracts that you saw initially, they're not actually traded there. So how are you going to have any faith behind that? And it doesn't give you direction, because there's lots of orders above and below market price. There's ladders above with price levels and below market price. So what's making you feel so sure that the number of contracts that you're looking at on this DOM, depth of market, it's not dome, what constitutes the reasons why you should expect the price going up to that level or down to that level? When if you really look at it, it's generally a pretty much an even distribution of how they bracket all those things, because they're controlling you, they're influencing you with those things. They can do a lot of stuff just outside the range of market price. And a lot of you collectively, even though you're small fry retail traders, a lot of you are looking at those things, and they only need one contract of your trading to book price and cause all kinds of chaos and ripples to go through the marketplace. So yes, they can use the back of a retail trader's order and break the market and start the spooling effect and take price wherever they want to go. Markets don't always turn on big volume. And if you studied volume, you'll know that a lot of times when the market makes a high, they're doing it with less volume than the previous volume seen at the previous high. So think of it as a false breakout. In that sense, volume does precede price. But I already expect that type of stuff happen before volume ever even comes into the conversation. So I don't look at those archaic tools, those reference points, because I know how liquidity is going to come in the marketplace. I know. And you don't need any of these external tools. All you need is a chart, the open, high, low, and close, and what time is the high and that low formed. Asia session, London session, pre-market session, 7 o'clock to 9:30 open. And then you have the 9:30 to 11 o'clock, where is your liquidity in that, because that's your AM session. And then the lunch macro will pull against that. Even if it's going to stay consolidation, or if it's going to reverse or continue, it's going to go back into the range for that liquidity that was formed at 10 o'clock, going into whatever it has done during the lunch hours. It does this every day, folks. Every day it does that. And then you have the PM session, which will use the lunch macro liquidity and or the AM session liquidity. And that cycle repeats over and over and over again. They cannot hide it from you. They cannot cause any kind of distortion in your data. Okay, everybody is going to have the same price high and low across all the brokers, because you're trading in a real market. You're not trading a CFD. You're not trading in forex, where every broker gets to mess around with the highs and the lows. That's what makes these markets better. They're a gentleman's market. They're not a cowboy that wants to ride like on a crypto market where everybody gets a chance to do stupid stuff. So I jawboned a little bit there. I apologize. But I want you to take a look at this area right in here. We're zoomed in now, and I want you to see all these highs here are just falling short of this area right in here, this SIBI, sell-side imbalance, buy-side inefficiency. Minor buy-side liquidity here. The market stays in this consolidation. So at 9:30, we open, we hang around, bang around, bang around, bang around, and finally retrace back up, because if it's going to go down, they're going to price in a premium, and they're going to take out some measure of buy-side. And that's this area right here. Trades right up into that level, and then breaks, comes back up, breaks one more time, and in here, I'm looking for a short, because we're in the lower portions now of this SIBI. Add in the other, which I'll have in my charts in a second, but the way I teach first percent to fair value gap, this week I pointed out several of them, and you're instructed by me to always project them in the future. So in TradingView, you just toggle it, extend to the right. And if you do that and you label them, as you'll see mine in a moment, it helps you stay organized. But you don't have to have all these things on your chart that you're looking at every day, all day long. You should always have a naked chart, nothing on it, because it allows you to see things with a blank slate or a canvas that doesn't have any paint on it. It gives you a fresh perspective constantly. So throughout the day, throughout the morning session, the afternoon session, I'll take everything off my chart and look at price action like that. So that way I'm not marrying the idea. I'm not forcing my will in the marketplace, because by having all these annotations on the chart, if I'm making examples for you and I'm executing and taking live trades, these annotations are not necessarily on my chart when I'm trading, because I don't want to force that outcome on my end result expectations. And you can do that by dressing your chart a lot. And by managing the information that you're curating, taking all of these things, first presented fair value gaps, new week opening gaps, new day opening gaps. I have nothing on my chart, no reference at all to those there. Like I'm not looking at new week opening gaps or new day opening gaps in any of the things I'm showing you here today. All of those things add, but you don't have to apply it to every, well, not to every, to the chart you're looking at, your bellwether chart, the one you look at basically majority of the time throughout the trading sessions that you're trading. You want to have templates. You want to have things that you can toggle and refer back to periodically. Like every couple of minutes, you would say, where are we at in regards to the last 5 new day opening gaps? Where are we at in regards to the last 5 new week opening gaps? Where are we in regards to the Asian session liquidity from earlier in the week, Monday or Tuesday or Wednesday? You want to constantly be referring to all those pools of liquidity. And you will start to see the rhyme and reason of what price is doing. But until you start keeping a log of all these things, you won't fully appreciate what I've been teaching all these years in front of you and in executing on it. My students executing on it. The fact that you can't identify any of it is because you're not annotating your chart and logging them and collecting them and then studying at the end of the week. Before the week opens up, you should have already spent about 30 minutes to a maximum of an hour reviewing where the turning points took place intra-week, intraday. What was the weekly high and the low? How did that relate to what the weekly chart and the monthly chart is suggesting? And you get closer to what the market's doing by doing things like that. All right, so this is your first presented fair value gap. And consequent encroachment of that gap is here. So you can see we traded up into it, bumping the buy side. Consequent encroachment of first presented fair value gap at 930. Breaks lower, comes back up, hits it one more time there. And we're staying outside of what? The upper half. That's order flow theory with my PD arrays. It's always like that. It's always like that. And no, you don't find that in any books. I had another joker on X yesterday talking the same nonsense. It's all these concepts have always existed, but they never tell you what book, what author, what page number, and show them doing what I'm doing here. It's not there, folks. It's not. And I love sound like a broken record because it needs to happen, because you have AI. And the more people constantly put out there false information, they will lay down a false narrative saying that this was stuff that was seen in books. And that's why I challenge people. That's why I remind all of you, I have $5 million US that says you can't find my work anywhere prior to 1996. It's, in fact, you look at it like this. In 2016, when I started doing paid mentorship, that's when I was revealing it to the public in a broad range where I wasn't doing it one-on-one like I was in the 90s. So 2016, you don't even have to go back prior to 1996. Just go to 2015. Okay. Can you find it there? No. It exploded because my mentorship was so sought after. And everybody copied it, everybody parroted it, and they all sample from it. They all sample from it. That's okay. I mean, that's what a teacher wants, right? He wants students to learn. But there's this movement. They want to try to hide the fact that I'm its originator, I'm its creator, and I codified these things. And they did not exist in any form, fashion, any way as you see me teaching and using them. And that's why no one else handles them as well as I do. You are forced to look at these concepts through your own perspective during the times that you can trade, during the times of your study. And you're going to see that the way I have created this language for you, you can engage this algorithm, this market, and do things that fits your schedule, your personal life, your personality. you're given the freedom to pick whatever PDA array you want. Who says that you have to be at the high when you're shorting? You don't. Who says you have to be at the low when you're going long? You don't. I don't always get the opportunity to be in front of my computers when the setup's there and I can't enter the trade right at the low or the high. So I'll use continuation ideas that my PD arrays offer me. Because I'm looking at order flow, I'm trusting that what I'm expecting to be delivered, I can still frame a trade and manage risk, in a manner that's not excessive. So let's break this down a little bit further. So as the market drops down in here, there's a fair value gap there. And then there's volume imbalance right here, separation between the bodies. So the market trades up into that and then breaks down, trading down into Friday's London sell side liquidity pool. All right, in the minute chart here, you can see I've identified the Friday London session liquidity, Friday Asian session liquidity, and then Thursday's regular trading hours. And earlier in the video, I told you to look inside that low, and you'll see that there's a little fair value gap right there. It's a buy side amount, sell side inefficiency, and we traded right down into that. You see that? So what is this level here? If you measure the opening range high to low, and you run a negative 1.5 standard deviation on your fib, you'll get that projection that takes us below both London and Asia sessions liquidity right here. So that's the level. And it trades down to that inefficiency, but not needing to take out Thursday's low. So here is that zoomed in, that little fair value gap I was quizzing you on earlier in the beginning of the video. This is what you should have seen. And we don't need to see Thursday's regular trading hours sell side liquidity be taken. All right, so stripped down in a normal fashion, this is what my charts usually look like, and it looks like this when I'm doing the execution. When I'm showing it to you, here's the bump on the buy stops. Here's the opening range gap. First presented fair value gap. Inversion fair value gap. See this low here? That's the start of a new day. This is a first presented fair value gap at the start of the new day. Project that forward. You can see how it's being used here. And then they finally bump through it, leaves it, never comes back. That's a good thing. And then you have this sell side imbalance, buy side inefficiency here. Project that forward. And then here's a minor sell side liquidity that attacks. And then you have volume imbalances in here. And you can see all that, how that was used in the recorded execution. And then you have Tuesday's PM session first presented fair value gap. It draws down into that too. So look at the bodies respecting that. Think about that. It's interesting, isn't it? You're going to tell me that's buying and selling pressure. Everybody that doesn't follow what I teach somehow agreed to be buying and selling to afford the opening price and the closing prices of these two candles to reflect the respect of that Tuesday PM session first presented fair value gap. You're going to push real hard to make that argument, and I'm going to laugh in your face. All right, so we're going to moving in to a little bit more of the morning session here. We project that forward at fair value gap. Now we change its character from that of a sell side imbalance, buy side inefficiency, which is going to be used to sell off further to get down to our target. But now when the market has done our target, it's going to consolidate and trade above it. And now it changes its character. Its initial bearish character now becomes bullish. Look at respecting the consequent encroachment here, rallies back up into the actual first presented fair value gap at 930, falls short of going into consequent encroachment, comes right back down in fair value gap. You can do that on your own with sell side. Hits it, rallies, comes back up in, volume of balance, rally, and then we get back up inside of the first presented fair value gap. You're going to want to put your gradient levels in there. So in other words, you're going to use the high, upper quadrant, consequent encroachment, which is midpoint, lower quadrant, and the low. Put that on. I just didn't want to have it on here because it's too busy, but you can see that that's what's occurring here. It trades up, comes down to lower quadrant, consequent encroachment, upper quadrant, and you're seeing the beginnings of the afternoon session in here. But this is the morning AM session, opening range gap, first presents a fair value gap. Huge, lots of things in there. Sounds like word salad, but this is what separates the lazy from the people that really want to understand how to manage risk, know when setups are going to form, never fall victim to fear of missing out, never fearing a shortage on supply of trades. Okay, these things happen every single day. What do you think the professionals are doing? The people that aren't teaching like I am, they're out there in these big institutions. What do you think they're doing? You think they're out there guessing all the time, something different every day? No, they have models. They stick to rules. And I'm giving you time and price analysis. That way you can tap into these setups that form every single day. They cannot hide it from you. You don't need extra, level 2 institutional tools and all this other stuff. They want to try to sell you these gimmicks. They're all used against you. All of them. The things I'm teaching you, it is the market. Right here's the afternoon, and you can see that is the first presented fair value gap for the PM session between 1:30 and 2 o'clock Eastern time. The market trades down to the low of the actual AM first presented fair value gap, rallies back above, consequent encroachment, and then look how it accumulates inside of the first presented fair value gap between 1:30 and 2 o'clock. It helps you identify the actual fair value gaps that's going to help you know which one to trust. A lot of you don't realize what I've done. Okay, I've pulled back the veil and I'm teaching you how to never fall victim to picking the wrong fair value gap. You'll never find that in any fucking books besides what I've wrote and codified and people have already put out there incomplete. They don't have all the full information, but they're trying to rush it out there to put it in print form. I have a book that was teaching that first, but you parroted what I said in my mentorship lessons, and it's incomplete. All those things are incomplete. My books will fill in all the gaps. That way, the ones that have rushed to put books out there are going to look like fools, and that's okay. But the first presented fair value gap gets used here in a reversal of what its original character was. Over here, it was bullish because it's a buy side imbalance, sell side inefficiency. The market can use that if it trades back down into if it's bullish. But what happens if you're seeing the market trying to trade higher? It's used here to send price up. And then what happens when it trades below it? It changes its character. Now it's using consequent encroachment on that level to send it down into sell side liquidity over here. And zoomed in here, you can notice that we had sell side, buy side, this run here during the 315 to 345 macro rallies, last hour of trading. Look at the Thursday 60-minute premium wick. Okay, the highest 60-minute candle on Thursday's trading, there's a wick on it. Measure it so it shows just the 50% of the wick. That's what this level is here. That's the consequent encroachment of Thursday's 60-minute premium wick. It hits that, sells off, consolidates, and breaks. We have a shift in market structure here. Here's model 2022. Fair value gap. Breaks lower, trades to PM session first presented fair value gap. That's always low-hanging fruit. And then it trades to the low of it, attacking the sell side here, and then just extrapolates to the downside.